Welcome to another edition of the Weekly Market Note. I'm Alex Varner, our head of research, alongside
James Maxwell, SVP of research.
Nice to be back in sunnier, warmer California after last week in Chicago and
Welcome
Buffalo.
back.
Yeah. I did see elk in Chicago, and I think it's why it's called Elk Grove, the neighborhood we were in, which was interesting. As usual, our product offerings, and we always like to remind people, if you're interested in working with us, please reach out or comment on this, or however it works. Somebody will reply to that if that's the case. As for performance, as you can see there, the bottom two slides are the weekly performance, and things are mostly in the red.
Mm-hmm.
You're getting more talk of a pullback. I don't think we're not in correction, but there's a little bit more talk. Although today, Monday, we're back in the green. You can see still year to date, things are resoundingly positive. Consumer staples is the only sector in the red year to date, and then internationally you can continue to see emerging markets, Euro stocks, developed markets, all country leading the U.S. pretty handily still. Getting into the recession dashboard, not a ton of changes here in December. I think, as we've been kind of muddling along for the time being, you're seeing more talk on the Fed, and I think now that the CME group pricing for the Fed cut is down like a coin toss, basically. I've seen a couple other folks, kind of, economists or what have you, saying they have changed their mind that or changed their call going from a cut, was it 2 weeks out, I think, to a pause, which you saw kind of Powell with that language when you're driving a car in the fog. What do? You slow down. So this week is Thanksgiving. The Farm Bureau is out with its annual cost of Thanksgiving dinner report. This is for 10 people, keep in mind. But basically, good news, it's down 5% from a year ago, coming in at $55.18. Last year was at $58. Turkey was the kind of main, I don't want to say culprit because that sounds bad, but as the main driver in bringing down that overall cost, down 16% to $21.50. On the other hand, you've seen some of the side sweet potatoes up 37%, carrots and celery up 62%, and green peas up 17%. And again, these are on a dollar basis, pretty small relative to the overall cost of dinner, but still, some things are going up. And then, it's still down 14% from 2022. But we are 13% higher than 2019. So a couple of different comps there, but you saw there was a big spike in 2022 to like $64. But we're still so we're come off of that, but still above 2019. And then, it is worth keeping in mind that since 2019, wages, which are what people used to pay for Thanksgiving dinner with, are up 29% over that time frame. So while you're up, wages are up more than double the cost of the Thanksgiving dinner. And it is trending kind of back in the right direction the last couple of years in a row here. For the kind of hard data, we finally got the September non-farm payrolls report. Better late than never, I suppose. They've already come out, or the BLS has already come out and said we won't be getting an October report for either employment or inflation. So that's kind of a gap in the data. But the September report showed, 119,000 jobs added. That was more than double forecasts for 50,000 and the best month since April. August was revised down negative, so that's the second decline this year. But the labor force is up by 470,000. The household employment figure was up by 251,000. The number of unemployed persons was also up by 219,000, and that pushed the unemployment rate higher, which we'll touch on in a sec. But basically, this is considerably stronger than anticipated. It's also worth mentioning that the break-even rate with the changes in immigration has really come down. It used to be 150, 200,000. And now it's, somewhere we've estimated kind of 25 to 50,000. So this is well above that replacement rate. And again, 1 month doesn't make a trend, but hopefully you start to see some bottoming of that kind of 6 month average, and it'll start to move back higher because we had a couple of, 3 of the last 5 months have been pretty weak. On the industry and wages section, looking through at what industries added, you saw education and health services led the way up 59,000, followed by leisure and hospitality at 47,000. Trade, transport, and utilities lost the most, shedding 25,000 jobs, and the professional and business services were down 20,000. Earnings slowed a bit, up 0.25% month over month, and running at 3.8 year over year, which is still, you've seen this, that's that blue line on the right there. And it's been this kind of steady moderation, very slow kind of tapering out. And we're still running above pre-pandemic levels. I think that's worth noticing that, or worth mentioning that people like, oh, it's the lowest in 2 or 3 years, and year over
Yep.
year, the 3 month average, it's still above anything we had prior to 2020. So the relative gains are strong. And then, as we mentioned before, you saw a tick up in the kind of headline U3 unemployment rate to 4.4%. That's the highest since October of 2021. And then on the other hand, you saw the U6 rate, which is a little bit broader and encompasses people who are like, discouraged or demoralized or kind of marginally attached, tick down to 8.0% from 8.1. So I think, there's some concern about that unemployment rate. But again, the headline number 120K was solid,
Yep.
119K was solid, and there are multiple moving pieces. The unemployment rate is a ratio, and
Yep.
so you can have both fluctuations in the top and the bottom that can drive kind of that thing on an outsized basis, 1 month versus another. So we don't read a whole lot into that. It's kind of steady as she goes.
It's also at this point a month and a half kind of delayed or out of date.
Yeah.
It's coming from September. It's already middle of October, end of November here.
Yeah.
So, and we're not even going to get the October report, as you mentioned earlier. I think one thing that we've been looking at, there's a couple more live data points that you can look at. Layoff announcements, those kind of have been moving up, paired with unemployment claims. Those have been more steady. If you look at the kind of weekly unemployment, new claims, and then also continuing claims.
Yeah.
Those have been kind of less aggressive than you kind of expect, which is good. And those are kind of more live than obviously this data, which is again a month and a half.
Yeah. And this is the sort of thing where it's like when you get the GDP figures, it's like a month and a half delay. It's like we lived through this. Like this happened 3 months ago.
You kind of already know.
Yeah.
You kind of already know.
You don't see a big reaction in markets to this sort of thing because it is in the past. It certainly does influence policy. But I think this is kind of on the margins, not much of a change. On the right, we showed the labor force participation rate. That was unchanged for the 25 to 50-year-old. That's kind of the prime working age cohort. It's good to see that pop last month. Hopefully that'll continue to kind of grind and maybe break out of that kind of range-bound area it's been in. And then the overall rate continues to move higher up, 62.4. That's the highest in a month or two. And that thing has kind of been trending lower. So it would be nice to get that to kind of turn around and see if that starts moving higher. Switching gears a little bit, we got the balance of trade. Trade has kind of been a little bit more in the picture because of the tariffs and the fluctuations that it's had. You can see earlier in the year those import and export pictures on the right and on the left as well. Just some big spikes as people were front running on the import side, especially. But the trade balance narrowed to $59.6 billion in July. It's a deficit. I mean, we're still talking about July and it's almost December. So this shutdown has done nobody any favors on the data side. Imports were down 5.1% month over month. That's the most since April, while exports ticked up basically 0.1%. Imports are now at $340 billion and exports at basically $281 billion, kind of moderating from that spike and mostly continuing in their kind of pre-tariff trends. The drop in imports was led by a $9 billion drop in non-monetary gold. So some of the ways these things are considered, like you think about that and you're like, that doesn't really an import in kind of the traditional sense that I think of, and there's some accounting here. And also, that 9 billion non-monetary gold, if you'd taken that number a year ago, it's the same weight, but it's a different dollar amount because of the way gold prices have been moving. So the price movement of commodity is having an outsized effect as well on the trade numbers. But then on the export side, capital goods ex autos hit a new all-time high. And on a year-over-year basis, imports are down 2%. It's the most negative since October of 2023, while exports slowed to plus 1.9%. And that's its lowest since Jan of 25. So you're kind of seeing some more moderating figures, I think, here but again, the overall dollar amounts continue to kind of paint a picture of steady uptrends and decent growth. On the goods and services side, goods comprise the bulk of the trade. They're up basically 80% of imports and 65% of exports. So people focus a little bit more on the goods there. And especially when you're talking about the tariffs are applied upon goods, not on services. So that was a little bit more in focus as well. But basically, goods imports fell 6.6 month over month to 265 billion, and they're down 4%, 3.8% year over year, which is the most negative since October of 2023. That's kind of driving that headline number. And the goods exports were down 0.3 at 179 billion and slowed to just 0.6% year over year, which is the smallest rise since December of 24. So again, continued moderation kind of on the trade side. And then services, on the other hand, on the right, you can see the blue and the red lines have been just grinding higher. They've been
Yeah.
steadily increasing. They are kind of slowing on a year-over-year basis, but again, that's just on the comparisons. The dollar amounts continue to rise to new all-time highs for both imports and exports. So you're kind of, unexpectedly, the services haven't seen that same type of volatility
Yeah.
that that the goods have based on those tariffs, as
Which
they're
makes sense. Yeah.
immune to them, essentially, for better or for worse. This was an interesting chart. We're talking about CapEx, and you hear a lot of talk on the AI spend and the hyperscalers and da 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 da. And you kind of, if you look at prior periods of technological innovation, here we've got railroads, auto infrastructure, so roads, the electric motor, then you have tech hardware, which is like the personal computer boom, and then you have telecom as well in that similar time frame. But basically, we're at, in generative AI in the 2020s, we're at 0.8% of US GDP on spend. And the point here is this relative level means there is still room to run
Yeah.
on these sides of things. And yes, it is a higher dollar amount because the economy is bigger than it ever was. But I think you're seeing the scale of these things is really kind of it's different than it was in the past. And I think those are the four most dangerous words are this time it's different. But this certainly seems kind of like it's still got legs to run.
Yeah. One thing I will say on this and the kind of work that we've done looking at these past tech cycles, tech booms, and we've kind of pushed this here internally is you want to own the kind of picks and shovels of these, big build outs. The railroads, for example, almost all of the actual railroad, building companies that expanded westward and laid the tracks ended up going bust because they spent all of this capital, massive infrastructure investment, and it didn't really pay off because it was hyper competitive. Versus the companies that had the steel or whatever that was being built into the tracks and all of that ended up doing very well. So and you kind of see that across all of these, the societal effects, the broader effects on the kind of global or at least US GDP were massive. The actual micro companies, there were massive winners and massive losers. So it speaks to the kind of broader diversification you want. Speaks to owning the inputs and the picks and shovels rather than maybe that actual distribution layer.
Yeah. Yeah. So this will be interesting to see. And I think with some of the recent market action, there's already talks of for so long you heard bubble, 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 and all of a sudden the bubbles burst.
Yeah.
And people are kind of out there, and it is kind of interesting to see how quickly that kind of pendulum can start to swing back. And usually the reality winds up somewhere in the middle.
Yeah.
So that's kind of where we're looking here. Talking about swings in sentiment, this was the CNN Fear and Greed Index. So that hit got all the way down to 7 last week. That's the lowest level since April during that market sell-off. You can see, this goes back to January of 24. So it's the second lowest level basically in almost 2 years here. And this is kind of an interesting contrarian indicator because generally forward returns from depressed sentiment points can represent an attractive buying opportunity. So again, this is something we kind of track internally. We also look at there's a crypto fear and greed, but then you get the kind of weekly AAII sentiment readings. And then as we've harped on, like the University of Michigan reading that we're about to get to, has been kind of depressed. So sometimes these depressed sentiment readings can provide a good option to buy.
One thing I'll say on this, it's kind of shocking to see how much fear there is when the actual broad like equity market, S&P 500 in this case, I think at the very bottom, this kind of downturn was down maybe 5% off the top. Versus in April, similar type of a reading on the fear and greed, the S&P was down. I think it was over 20 or 19.9 or something at the bottom. So just kind of a relative there. It's interesting to see the kind of underlying market dynamics very clearly risk off, even as the headline index has kind of remained strong.
Yeah, so we'll see how this plays out, but it's already come back a little bit. But again, this thing can also, it's daily, so it can fluctuate quite a bit given given a different given day. So kind of in summary, the cost of Thanksgiving dinner down 5% year over year. We're still up 13% from 2019, but down 14% from 2022. Remind you that wages since 2019 are up 29%. So that's a big, wages have been up and kind of more than kept pace. That's something we've talked about as even as inflation, did run, but it's come back. even as inflation has remained a little bit higher than recent history,
Mhm.
wages have continued to outpace that. So the real purchasing power remains, and that's shown in the retail
Yep.
figures and that sort of thing. The delayed September non-farm payrolls came in at a solid 119,000. The U rate did tick up a little bit to its highest since October 2021 at 4.4%, but again, kind of continued moderation here. The trade balance narrowed to 59.6 billion deficit as imports were down 5%, exports were up 0.1. And then again, kind of non-monetary gold was the main culprit behind that drop in imports. And then we also mentioned capex as a percent of GDP in this kind of AI build out remains well below historical levels. To us, that means there's more room to spend from
Mhm.
here. And then, kind of despite that upside optimism, the fear and greed, which is a far more, kind of high frequency indicator, but that hit its lowest level since April. As James mentioned, we're down 5%. Given today, we're
Yep.
even less than that.
Yep.
And yet, the last time I was at these levels, and we were down 20% off the
Yep.
highs in April. So you're seeing maybe a little bit of disjointed sentiment relative to kind of the market performance.
Mhm.
And then, we're still kind of muddling through the like data releases. But I think this week, despite being a short week, we get a slew of data. We get retail sales, PPI, durable goods. I think we're supposed to get core PCE income
Mhm.
and spending Wednesday. So there's a lot of data coming out this week that's kind of being caught up on. And these will be the
Mhm.
September data points. And then we won't get October. And then in like 2 weeks, we'll start getting the November. So I think
Yep.
we'll probably just draw a dot between the line between the two, and October is just going to be the average of whatever we get for September and November. So we shall see. But in the meantime, hope everybody's a great Thanksgiving.
Yep.
And yeah, thanks for joining us again. Talk to
All
you
right.
soon.